Hi everyone, welcome back to the audit session. Today we will be discussing about the management assertions. We have been quoting the management assertions so since a long time since we have started audit sessions, but I have told you several times that we will cover that in detail in coming chapters. So today we will be discussing in detail about the management assertions. So let's go through it and understand what's actually it is. So, in representing the financial statement are in accordance with the applicable financial reporting framework. The management implicitly or explicitly makes assertions regarding the recognition, measurement, presentation, and disclosure of the various elements of the financial statement related disclosure. So, assertions are in regarding to the recognition, measurement, presentation, and disclosures of the various elements of the financial statement and disclosures. So if we use a mnemonic that for the assertions, it will be cover up. So you can see here in the screen, COVER, cover UP up. So C, completeness, cutoff, valuation, allocation and accuracy, existence and occurrence, rights and obligation, understandability and classification. These are the broad uh, six. These are the broad six management assertions that is used widely in the financial statements. So let's understand what's completeness. So management asserts that all the assets, liabilities, equity, interest, transactions and events have been recorded and all the requisite disclosure has been included. That is, the financial statements are complete with all the events, all the assets, liabilities, profit, loss, transactions, disclosure. So it is the complete in a sense. So completeness represent that. Cutoff. Management asserts that the transactions and event have been recorded in the correct accounting period. So the correct accounting period has been used, especially used during the year-end transactions. If any transaction pertains to the current year but has been recorded in the next year due to certain technical glitches or certain logistic things, so it should be management's as a responsibility to it should be management's responsibility to take it into the account in the correct accounting period, to identify the which correct accounting period it pertains to and to report in the correct accounting period. Valuation, allocation and accuracy. Management asserts that amounts are valued as per the gap. Revenues and expenses are allocated to the proper periods. Transactions and disclosures have been recorded appropriately. So these pertains to the valuation, allocation, and accuracy. Like the valued, they are properly valued. They are allocated in the correct transaction statement, and they are accurate. Existence and occurrence. Management asserts that all the assets, liabilities, and equity interests listed on the balance sheet exist and disclose transactions and events that have been recorded, have been occurred, and pertain to the entity. Like that transaction should actually exist. Like that should not be something just to get the correct numbers and just to show the financial statement a good picture. That should not be anything that the users of the financial statements are misleaded by. So the transactions that are mentioned in the financial statement should exist and have occurred in the correct time and place. Rights and obligations. Management asserts that it is the legal owner of all the financial statements, that financial statement liabilities are represent the legal obligation of the entity, and all disclosed event pertains to the entity. So the legal title, the legal rights, the legal obligations are with the management, that should be ensured by the management. Understandability and classification. Management asserts that the information is presented and described clearly and the transactions and events have been recorded in the proper accounts. So that should be properly described in the simple English language, and that should be properly classified and properly disclosed so that it can be understood and classified and can be understood by the users of the financial statement in a proper language without any extra. Those who even don't pertains to the expertise in the accountancy, they can also understand that. Assertions used by the auditor to consider the different types of potential misstatement that may occur fall into the three categories. So there are three categories and 13 management assertions for those three categories. So assertions are about the class of the transactions and events of the period under the audit. Assertions about the account balances at the period end, and assertions are about the presentation and disclosures. So class of the transactions, account at the balance year end, and presentation and disclosure. So class of the transaction and events are basically our P&L income statement, account balances at the end are balance sheet, and presentation and disclosures are again the part of the financial statement. So our assertions are there are total 13 assertions, and they are defined in a way that those are classified among these three heads of the financial statements. So completeness belongs to all the three heads, like transactions, accounts, and presentation and disclosures. Cutoff is relevant to the income statement only. Like in the transactions, we need to check that they are recorded in the correct accounting period or not, and that is applicable in the case of transactions, class of the transactions and event, especially in the case of the revenue, to ensure that it is not misleaded and this is not recorded in the wrong accounting period. So to get the comfort over that, cutoff is used. So accuracy, allocation, and valuation, it was three. So among that, accuracy pertains to the transactions, allocation and valuations are the part of the balance sheet and the presentation and disclosures. So our transaction statement should be accurate, whereas the account balances in the valuation and the allocation of the assets should be properly done in the balance sheet and the disclosures. Similarly, there were two assertions, occurrence and existence. Occurrence is relevant to the transaction statement, whereas existence is relevant to the balance sheet. In the existence, we ensure that the assets, that inventory are in actual existence, that actually exist, whereas in occurrence we check that the transactions have occurred while they are getting recorded, they are actually occurred in the place. Rights and obligations pertains to the balance sheet and the presentation and disclosures, where we check that the entity has the legal rights for the liabilities and the assets, and that is more concerning more part for the balance sheet and the disclosure statement. Classification again pertains to the transaction statement, that the revenue and expenses are properly classified and properly recorded, and again under the disclosure, like disclosures are properly understandable and classified accordingly, so that it is understandable by the users of the financial statement. Now talking about the relevant assertions for the class of the transactions, account balance, and disclosures. These are used by the auditor to assess the risk of the material misstatement and to design and perform the further audit procedures. Relevant assertions are those that have a meaningful bearing on whether the transactions account disclosure is fairly stated. Not all the assertions will be relevant by the auditor. Like valuation may not be relevant to the cash account unless currency translation is involved. However, existence and completeness are always relevant. So, while auditor uses those assertions in identifying the RMM, auditor should be mindful that not all the assertions are applicable to the all heads, all the accounts, and all the disclosures, and those are those should be properly classified and properly used wherever applicable. Just like valuation may not be relevant to the gross amount of the account receivable balance, but it is relevant to the related allowance accounts. Also, in some circumstances, auditor focus on the presentation and disclosure assertions separately in connection with the period and financial reporting process. So this should be kept in the mind while assessing the RMM and doing further audit procedures. Identifying relevant assertions include determining the source of the likely potential misstatement. Attributes including the particular assertions are nature of the assertions, volume of the transactions or data related to the assertions, nature and complexity of the system, including the use of IT. Also, in identifying and assessing the RMM at the relevant assertion level, auditor may conclude that the identified risk related more pervasively to the financial statement as a whole and potentially affect the assertions. So this was all about the management assertions and how auditor uses it in auditing. I hope you understood this, and let me know if you have any queries in the comments. I will help you to resolve all those out. Thank you and bye.